NFP days can be great to illustrate how markets move because they really have the potential to motivate traders to act. Not only is there the potential for a lot of movement, but there's usually a good mix of different types of participants active in the markets, and it can be really important to know who's trading and why on these kind of days. So the backdrop to all of this is that the central bank policies are the main driver right now for the markets as a whole. The QE programs that many central banks have implemented since the financial crisis have become somewhat of an obsession and even an addiction for the markets. The Federal Reserve's QE is no exception. As economies become more stable, however, the issue is that QE and low interest rates can lead to high levels of inflation if left unchecked. So fundamental news such as NFP, inflation data, central bank meetings minutes, and whatever else they say they are currently looking at tends to bring about a surge in activity due to the heightened level of importance it currently has. With the Fed basically saying that they will raise rates at some point fairly soon, the NFP release, which is pretty important anyways, gives the markets an opportunity to figure out the likely impact of jobs growth amongst other important jobs data that's released at the same time. Scalpers, swing traders, banks, funds, and everyone else are all therefore likely to be active. Day traders frequently struggle to grasp the relationship between different markets, and unfortunately, because these relationships sometimes seem so clear, they start to lean on them as a tool to help in making context-based trading decisions only to find out that they don't hold. For example, it appears that day traders commonly believe that the relationship between stocks and bonds is inverse. When stocks go up, bonds go down. And this is something that can happen. But the relationship is usually not directly between the stock index and the bond themselves. Whatever the relationship appears to be is a consequence of what is driving the overall market. In this case, the driver is the Fed interest rate policy. In essence, when interest rates go up, bond prices discount this, and as low rates are meant to be supportive to an economy, stock markets go down. So given that both stocks and bonds could sell off in anticipation of higher interest rates, can you tell the difference between the two charts here, between the stock index and the bond? Okay, some of the prices gave you a clue, but they're very similar, especially over the final days where the NFP was released. Trying to trade one against the other with expectations of an inverse relationship would prove pretty costly. Understanding the potential drivers is, however, the first stage of trading. The next stage is to have a plan for what you think will happen, and therefore what you might do given the various possibilities of how the data might come out relative to expectations. This doesn't have to be a well-documented plan. It's just good to have an idea of what could happen before the event itself. So for the NFP release, the expectation was plus 235,000, and the previous figure was plus 257. If it came out in line with or close to expectations, then expectations of what the Fed might do with rates would be the same. A much lower number, at least below 185, and the Fed might think twice about raising rates in the near term. Much higher, like above 285, and the Fed might have to consider accelerating the process of moving towards raising the rates. It came out at a strong plus 295,000, with the previous revised lower by 18,000, and overall plus 42,000. Liquidity, short-term news players, and probably the various other numbers released played a hand in an initial pop higher, but then the last scenario played out with stocks and bonds moving lower for much of the session. The final stage, of course, is to see how the market reacts to the release, as you never know what will happen. But if you know who's trading and why, or at least you have a good idea, you're going to have a much better idea of what could happen when big numbers are significantly different to expectations and the likely extent of subsequent moves. Now, recognizing this behavior when you see it will help you switch gears and make sure you are on the right side of the move.